Hi, I'm Rabiatul Adawiyah.
I'm Noatul Shaira.
I am Hasmiza Shamira.
My name is Sharifah Batrisha and we're from
Darjah 5 Squad. So our topic is about sources of equity financing.
So enjoy!
What is equity financing? Equity financing is the process of raising capital through the sale of shares in an enterprise. Equity financing and NBSP essentially refers to the sale of an ownership interest to raise funds for business purposes. There are three sources of equity financing. One of the sources is selling stock. Selling stock can be divided into four. First is initial public offering. Initial public offering (IPO) is the first time that the stock of A and NBSP, private company and NBSP, is offered to the public. Next is secondary market. The secondary market is where investors buy and sell securities they already own. It is what most people typically think of as the stock market, though stocks are also sold on the primary market when they are first issued. Third is common stock. Common stock is a security that represents ownership in a corporation. Holders of common stock exercise control by electing A and NBSP, Board of Directors and NBSP, and voting on corporate policy. Fourth is preferred stock. A preferred stock is a class of ownership in a corporation that has a higher claim on its assets and earnings than common stock. Second sources of equity financing is retained earning. Retained earning is referred to the percentage of net earnings not paid out as dividends, but retained by the company to be reinvested in its core business, or to pay debt. It is recorded under shareholders' equity on the balance sheet. The third sources of equity financing is venture capital and private placement. Venture capital is financing that investors provide to start-up companies and small businesses that are believed to have long-term growth potential. For startups without access to capital markets, venture capital is an essential source of money. Risk is typically high for investors, but the downside for the startup is that these venture capitalists usually get a say in company decisions. Private placement is the sale of securities to a relatively small number of select investors as a way of raising capital. Investors involved in private placements are usually large banks, mutual funds, insurance companies and pension funds.